Jerome Powell just spoke at the Jackson Hole Symposium. Economists, analysts and investors were eagerly awaiting this speech to see not only what Jerome Powell said, but also what it meant for markets moving forward and how they would react. Well, as you can see here, before the end of close at the time of this recording, the S&P 500 is down by nearly 3%. Markets have sunk. Jerome Powell was, on the balance of all things being equal, relatively more hawkish. This was what most people were anticipating, but it did seem like the market needed the tough medicine. It doesn't look like the Fed pivot is coming anytime soon, and they're going to be willing to do whatever it takes to bring down this inflation. Let's dive into what Jerome Powell said, and most importantly, what were some of those key learnings and takeaways about where this rate hike cycle might head from here moving forward. So before we dive into that, Jackson Hole. If you're not familiar with what Jackson Hole Symposium is, for a quick summary, it's an economic symposium held each year. It's been going for over 30 years. It's hosted by the Fed Reserve Bank of Kansas City, but it brings together many of the smartest minds and thinkers in the economic and finance field, as well as many central bankers. If you are interested and want a deeper dive into it, we did a video tucking into what Jackson Hole is. We'll leave a link to that after this one that you can check out. I'd love to know your thoughts too, so drop in a comment below what you made of Jerome Powell's speech, and then also, what do you think it means for markets for the second half of 2022? So it's worth noting as well that this year's kind of mandate or focus for Jackson Hole was around reassessing constraints on the economy and the monetary policy picture. Obviously, it's pertinent with the rate hike cycle that central banks around the world have started to pick up on. But what did we learn? Jerome Powell was hawkish. It was what most market participants were hoping for, that they'd be willing to kind of put their foot down where they needed to, stay the course, despite obviously a few interesting things happening with the economic data. While higher interest rates, slower growth and softer labour market conditions will bring down inflation, they will also bring some pain to households and businesses. They've expressed that they understand that obviously it's going to bring down demand, which ultimately they want, but there's going to be difficulties ahead. They've acknowledged it, and they're not kind of putting a blind eye towards that. Obviously, we know that inflation is the aim. The Federal Reserve, as well as other central banks around the world, want to get inflation back to that 2 to 3% band sustainably, which is that key focus that they've stated. And the reason and the key driver is, as we've talked about on the channel, the burdens of high inflation fall heaviest on those who are least able to bear them. It disproportionately affects the lower to middle income earners. Obviously, inflation is a regressive tax. So as a result of that, they're willing to do whatever it takes, and they find this critical. In terms of what the Federal Reserve and other central banks want to see, we know what it is. They've laid the recipe out there. They obviously want a slow growth. They want to see kind of the effects start to flow through to the labour market. They wouldn't mind to see a tick up in terms of unemployment, but obviously they don't want to curtail demand and growth and really put the brakes on too hard and kill this economic recovery before it's had time to really find its foothold. That's the soft landing. That's what they're trying to navigate. In terms of some insights from Jerome Powell's speech, he said the labour market's strong, but it's clearly out of balance with demand for workers substantially exceeding the supply of available workers. I'm sure most people are familiar, whether it's at your workplace or if you've been looking on job boards, whether it's LinkedIn or other websites, you've probably seen significant availability. People are willing to do whatever it takes to hire good staff in and to be able to fulfill the demand that they're seeing. Inflation's running well above 2%. High inflation's continued to spread through the economy. Obviously, we saw the lower inflation reading for July, which Jerome Powell acknowledged, 8.5%. Off the peak of 9.1%, but heck, it's still a far way away from that 2 to 3% band. And so they've stated that the single month's improvement, it's good, but it falls short of what the committee will need to see before they're confident that inflation is moving down. So they want to see more evidence, and this will flow through the data. What was really, really important here is the Fed pivot. Obviously, the Fed put is gone. We're in a higher inflationary period than we've been at any point over the past few decades. But the thought was, when will the Fed pivot? Are they going to blink, potentially blink too early? Or are they going to hold the course, hold their reserve? And that resolve, and that was really what the market here was fascinated with. And we can see it. Powell referenced previous attempts by the Federal Reserve to bring down inflation. But he stated clearly that history has taught the central bank that not acting quickly on prices will likely only mean a bigger hit to the labour market in the long run. And reversing course too quickly, if they blink, will also backfire. You can't be kind of 1 foot in, 1 foot out. Powell said, implicitly playing down investor expectations that the central bank's potentially going to move too soon to pause or reverse course. And Powell stated, the historical record cautioned strongly against prematurely loosening policy. This was as clear-cut of a message as we could have had, and most market participants, probably on the balance of all things being equal, were hoping to see this coming into Jackson Hole. In terms of monetary policy implications, we're all familiar with it. We know that we've seen a couple of outsized 75 basis point rises over the past period. Questions were, would we see another one for September? Obviously, the Federal Reserve took the month of August. They take it off. They don't have a decision in that month. So the question is, what happens to September? We'll wait to see the next wave of economic data before that. And it seems the Federal Reserve will be waiting to view that based on the totality of the incoming data and the evolving outlook. Obviously, it's on a month-by-month, print-by-print basis. At some point, the stance of monetary policy tightening further, it will likely become appropriate to slow the pace of increases. But on the other side, restoring price stability will likely require maintaining a restrictive policy stance for some time. So they're stating this cycle potentially could go for longer. It's not as if we're just going to be stopping around here. Obviously, this was the mention about prematurely loosening policy and needing caution against that. But committee participants' most recent individual projections from the June dot plots, and we've talked about the dot plots before on the channel, shows the median federal funds rate running slightly below 4%, but in the high 3% area through to the end of 2023. What's interesting is we will get another dot plot at the September meeting, so it's going to be interesting to compare them on a one-for-one. Obviously, the dot plots are just individual projections of individual Federal Reserve members, but it's always good to see kind of the sentiment and the lens that they're viewing these decisions through. In terms of the key lesson, Jerome Powell actually spoke about 3 key lessons during his speech. It was an interesting one. I'd encourage you to go away and listen to the speech. It's only about 10 minutes, so plenty to digest on that front. Before we get to the lesson, if you're new here, welcome. Plenty of videos on the markets and all things macroeconomics. So make sure you've subscribed, hit the bell notification on so you'll be updated with the new videos, and hit that like button as well. Welcome. In terms of the key lesson itself, Jerome Powell basically stated they must keep at it until the job is done. We all know about the great inflation in terms of the 70s. It's been talked about significantly by all quarters as we talk about this current inflationary period. And obviously people try to draw parallels between that. But the lesson that Jerome Powell had was that history shows the employment costs, so cost and effect of the labour market, of bringing down inflation are likely to increase with delay. As high inflation becomes more entrenched in the wage and price setting, and that's when you start to see the wage price spiral. So it's not only about what is inflation now, but it's also about what are the inflation expectations from consumers and market participants moving forward. Because if you start to have higher inflation expectations, then people may bring forward their purchasing decisions. When they bring forward purchasing decisions, that obviously increases demand at this stage, and that can lead to increased prices and so on and so forth. And then that is where the wage price spiral begins. The successful Volcker disinflation, where he gave the market the medicine it needed and obviously brought the recession forward through, followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was necessary, but as you can see here, our aim, and it seems like Jerome Powell and the Federal Reserve and other central banks as a result of that still believe in it, is to avoid that outcome by acting with resolve now. So they still believe that they've acted early enough, or at least in time enough, to stem obviously what was significant amount of decisions that needed to come through with the Volcker disinflationary period, but it seems they believe in this soft landing to at least some effect of that. And to sum it up, Jerome Powell stated fairly clearly, they're taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. They will keep at it until they are confident the job is done. We've looked into a range of different videos looking into the macroeconomic picture, so here's a link to another one that you can check out after this one. A big thank you for joining us. Let us know your thoughts with a comment below. For now, stay well and happy investing.